Welcome to Understanding Surplus versus Home Equity. This video provides a clear breakdown of two commonly confused financial concepts and explains why the distinction matters for property owners and investors alike. What is home equity? It's the difference between a property's current market value and the outstanding debt owed to a lender. Home equity is your financial ownership stake while you own the property. Equity fundamentally refers to something owned and/or earned. Surplus refers to an excess of resources that remains after all obligations have been satisfied. In short, surplus equity is often called surplus funds, excess proceeds, overages, or overbids. Surplus equity is the remaining value or cash left over after a property is sold at a foreclosure auction and all superior liens and debts are paid off. For example, if a house with no mortgage is sold for $100,000 to cover $10,000 in taxes owed, the $90,000 remaining is the surplus cash. Do not confuse surplus equity with home equity. The key difference is that home equity exists while you own the home, growing with payments and market appreciation. Surplus equity is post-foreclosure cash held by a government entity, which must be claimed. This chart compares home equity and surplus equity. Home equity exists while owned and is linked to the property value. Surplus equity is held after foreclosure, is cash held by the government, and requires a claim. The key takeaways are: equity equals ownership, surplus is excess after sale, and you must know the difference. Surplus funds must be actively claimed. They are not automatic. Watch our related videos for more on recovering these funds. This video on property tax foreclosure recovery is sponsored by Tax Sales Overbid Recovery, LLC. For inquiries, please email info@taxsalesoverbidrecovery.us.